$120 billion. Seriously, take a second and let that number just sink in. That is the amount American households are paying every single year strictly toward credit card interest and fees. I mean, it's not buying them groceries, it's not paying their rent, and it's definitely not building wealth. It is literally just money evaporating into the ether of consumer debt.
Welcome to This Explainer. Today, we're taking a premium, deep dive look at official data from the Federal Reserve, the Bureau of Labor Statistics, and the Consumer Financial Protection Bureau to uncover the real truth about household finances. We're going to see exactly why this massive explosion in credit card debt is no longer just a personal finance failure, but a massive macroeconomic trap that's threatening the broader economy.
Section 1. The trillion-dollar reality. According to the New York Fed, total outstanding credit card balances have surged to an absolutely astronomical $1.25 trillion. And this isn't some niche issue affecting a small subset of the population either. Over 175 million consumers now hold at least one credit card. The sheer volume of this debt has fundamentally rewired the entire American consumer landscape.
But the really crucial point here is what this means for the everyday family. For the average American household, this immense structural debt burden translates to roughly $1,000 paid out annually just to service that debt. That's $1,000 stripped right out of household budgets every year, money that could have been used for savings, investments, or real emergencies.
Section 2. Inflation outpaces real wages. To truly understand how we even got here, we've got to look past the numbers on the credit statements and analyze the powerful economic trap that has completely squeezed the working class from both sides. It's basically a perfect storm. By May 2026, the Consumer Price Index, which measures the cost of living, shot up 4.2% over the previous year. But workers' real average hourly earnings, their actual purchasing power, that dropped by 0.7%. So everything costs more, but the paychecks are functionally shrinking. And notice the terrifying contradiction revealed right here in the numbers. Despite falling real wages, the Bureau of Economic Analysis data shows consumer spending actually increased by over $156 billion in just a single month. People are literally making less in real terms, yet somehow they're spending more. It sets up an incredibly dangerous financial dynamic, which really forces us to ask the most vital question of this entire explainer. With everyday essentials costing more and real paychecks shrinking, how in the world are American families bridging this gap just to survive? Like, where is the money coming from?
Section 3. The interest rate squeeze.
Well, the answer to that question is as simple as it is dangerous. Families are basically forced to use revolving credit as a monthly liquidity bridge. They're swiping plastic to pay for groceries, gas, and utilities. And right now, Federal Reserve data shows that commercial bank interest rates on credit cards hit a punishing 21% in early 2026. When you are borrowing just to survive at a 21% interest rate, the math turns against you very, very quickly.
Now, this wasn't an accident. It was directly driven by the Federal Reserve's monetary tightening cycle to fight the very inflation that was hurting consumers in the first place. By maintaining the federal funds rate at around 3.6%, they've created historic borrowing costs. It creates this tragic irony. The people who most desperately need a financial lifeline are being charged the absolute most for it.
Section 4. The emergency savings divide. But here's the thing. This perfect storm doesn't hit everyone equally. It strictly divides Americans based on their financial buffers, specifically their emergency savings. Official data from the Consumer Financial Protection Bureau reveals a highly fragile reality. Nearly a quarter of consumers, 24%, have absolutely zero emergency savings. Another 39% have less than 1 month of income saved up. That means over 60% of the country is out there walking a financial tightrope without a net. And the stark inequality in this situation is just glaring. When we break the numbers down, roughly 40% of those with no emergency savings have severe past due debt, meaning they are 60 days or more behind on payments. Compare that to just 5% for folks who have at least a month of savings. Having cash in the bank isn't just a nice cushion, it is a literal shield against delinquency. The CFPB also explicitly notes that disadvantaged groups are disproportionately trapped without the shield. For instance, 41% of consumers with only a high school or vocational degree have zero emergency savings, compared to just 6% of college graduates. Lower income and non-white households are systematically facing lower savings buffers, leaving them totally exposed to the harshest winds of the storm.
Section 5. Delinquencies and rising bankruptcies. Slowing down for a minute to look at the human toll here, we have to examine what happens when those savings inevitably run dry and the credit limits max out. We start to see severe macroeconomic fallout. Official data from the United States courts reveals a grave consequence. Bankruptcies have risen a staggering 13.1% over the previous year. This isn't just a statistic on a spreadsheet. This is tens of thousands of American households formally declaring that the math of their lives has completely broken down.
On top of that, over half, 51%, of credit card holders are now carrying an unpaid balance after their last payment. They just aren't paying it off at the end of the month. High interest debt is no longer a temporary fix for a bad month. It's cementing itself as a permanent structural fixture of household finances. Section 6, the long-term consequences.
As we zoom out to the 30,000-foot view, we really have to seriously consider what this structural reliance on expensive debt means for the long-term health of America. With the personal saving rate dropping to just 3.0% of disposable income in May 2026, the cushion is effectively gone. Working-class families are left completely exposed to any future economic shocks, whether that's a medical emergency, a car repair, or a sudden job loss.
So I'm going to leave you to consider this one critical question. If our entire U.S. economy relies heavily on consumer spending, but that spending is increasingly fueled by 21% interest debt rather than real wage growth, what exactly happens when that lifeline inevitably snaps?